Welcome back to Chapter 4, Completing the Accounting Cycle. This is Part 2 of Chapter 4, Completing the Accounting Cycle. In this video, we will begin with Learning Objective 4.3. Explain the purpose of journalize and post-closing entries. In order to measure each period's net income separately from income of all other periods, revenues and expenses are closed. The closing process is a step in the accounting cycle that occurs at the end of the period. The closing process consists of journalizing and posting the closing entries to set the balances of the revenues, expenses, income summary, and owner withdrawals accounts to zero for the next period. A temporary account is an account that relates to a particular accounting period and is closed at the end of that period. You have the revenues, expenses, income summary, and owner withdrawal accounts. By contrast, a permanent account is an account that is not closed at the end of the period. That is your asset, liability, and owner capital accounts. They are not closed at the end of the period. Closing entries are entries that transfer revenues, expenses, and owner withdrawals balances to the owner capital account to prepare the company's books for the next period. This transfer also causes the owner capital ledger account to now equal its balance reported on the balance sheet. As an intermediate step, the revenues and the expenses may be transferred first to an account titled Income Summary. This is a temporary account into which revenues and expenses are transferred prior to their final transfer into the owner capital account. This account also summarizes net income or net loss for the period. Now, closing the revenue accounts require that a debit be entered into the revenue account in an amount equal to the existing balance. The matching credit is entered into the summary account. Next, each expense accounts receive a credit entry into an amount equal to the debit balance in each expense account. A matching debit is entered into the income summary account. Now, at this point, all the revenue accounts and expense accounts show a zero balance. The income summary account, when balanced, will have a balance equal to net income or net loss. The income summary account is then closed to the owner capital account. The owner withdrawal account has a debit balance and is closed with a credit entry to the balance in the account. The matching debit is entered into the owner capital account. In the case of Smart Touch Learning, the service revenue account showed a credit balance. of $17,500. A closing entry is prepared to debit service revenue of $17,500 and credit income summary for that same amount. Step 2 involves make expense accounts equal 0 via the income summary. An example here, Smart Touch Learning has a $3,000 debit balance in rent expense. So in order to close this account, a credit has to be made to rent expense. We prepare a closing entry for expenses by crediting each expense account and making a debit entry to income summary for the amount of the total expense balances. The income summary T account, after closing revenues and expenses, has a credit balance of $8,550. So you would arrive at this number by subtracting your debit from your credit, which will give you this balance in the income summary account. By debiting income summary for that amount, the $8,550, and crediting capital, Bright Capital for that same amount, now we have effectively updated Bright Capital account for the amount of the net income earned by Smart Touch Learning during the year. Step 4 will involve make the owner withdrawals account equal 0. You make it equal 0 via the Bright Capital account. In this example, Smart Touch Learning's $5,000 debit balance in the Bright withdrawal accounts will be closed to the Bright Capital. Here you see the Bright withdrawals, the $5,000 is going to be closed via the Bright Capital. So the balance of the Bright Capital on the balance sheet should equal $3,550. Smart Touch Learning's $5,000 debit balance in the Bright withdrawals account will be closed with a debit to Bright Capital. And here you see it's the journal entry. There's a debit to Bright Capital and a credit to Bright Withdrawal. So now the withdrawal account will be closed. Now, if a business had a net zero, if it had a net loss, okay? If a business had a net loss for the period, closing entries 1, 2, and 4 would be similar to those completed for net income. However, the closing entry to close the income summary account would be different. Consider this example. Suppose a business had a net loss of $2,000, as we see here. The income summary T account would hold a debit balance instead of a credit balance. Therefore, the closing entry to close income summary would be a debit to owner capital and a credit to income summary. So the effect of this closing entry decreases owner capital. Here in this Exhibit 4-6, it shows the complete closing process for Smart Touch Learning. Now this panel A journalizing, it gives the closing entries. These are the entries. Also here in Exhibit 4.6, it shows the complete closing process for Smart Touch Learning. And this panel here, panel B, shows the posting of T accounts. And these are the T accounts. Here you see Bright Capital has a balance of $35.50. The withdrawals account is closed, service revenue is closed. All these accounts here are closed, okay? And the income summary has a zero balance. Okay, here we are at Learning Objective 4.4, prepare the post-closing trial balance. So how do we prepare a post-closing trial balance? Well, after closing entries are recorded and posted, the accounting cycle ends with a post-closing trial balance. Okay. The post-closing trial balance is a list of the accounts and their balances at the end of the period after journalizing and posting the closing entries. It should include only permanent accounts. At this point, since all the revenue, expense, and owner withdrawal accounts have been closed, they will all have zero balances. The resulting post-closing trial balance lists only permanent accounts. These are permanent accounts. And it shows the debits and the credits. And you see here that the debits equal the same amount of credits. Now notice that the adjusted trial balance for Smart Touch Learning, Exhibit 4.1 that we saw in 4-1, notice that the adjusted trial balance and the post-closing trial balance are similar. However, an easy way to make sure that you didn't make an error in the closing process is to compare the adjusted trial balance to the post-closing trial balance to ensure that, one, account balances above owner capital are the same. Two, account balances below owner capital are zero and therefore not included. And three, the capital account balance matches the owner capital on the balance sheet. Okay, so this is the end of objectives 4.3 and 4.4, where we explain the purpose of journalize and post-closing entries, and also prepare the post-closing trial balance. In our next video, we will continue with learning objective 4.5, describe the accounting cycle. This will be covered in the next video.